Hello and welcome to this new edition of BCR Webcasting. I'm very pleased to be joined today by Professor Ed Altman, who is Director of Research, Credit and Debt Markets at NYU Salomon Centre for the Study of Financial Institutions. Professor Altman will be presenting next month at our 23rd Receivables Finance International. The topic will be for Professor Altman will be global zombies, an alternative type of corporate resiliency. Professor Altman, welcome. Delighted to have you here. I first came across your name many years ago. I think about more than 30 years ago.
Oh my goodness.
I think it was the Journal of Banking and Finance, and I was reading about your famous Z score. And for anybody who doesn't know about the Z score, it's a formula for measurement of the financial health of companies and a predictor of insolvencies. And I think I'm right in saying that it is still widely used within the banking and finance sector on a global basis.
Absolutely.
I should also add that I had a look at your very impressive Wikipedia page, and I see from there that you're author, co-author, or editor of 25 books. You were listed as one of the 100 most influential people in finance by the Treasury and Risk Management magazine. And you've also been given a number of honorary doctorates from various universities around the world. So we feel very lucky and very honored to have you here today and to be speaking at our event next month, Professor Altman. Thank you very much. And so today, what I want to ask you about, and this is just to lead into our event next month and to give our audience a flavor of what you'll be talking about um, in more fuller basis next month. Um, just give us a flavor of what is meant by zombie companies, how much of a problem it is for lenders, whether it's a problem at all for lenders, and also what it means for economies today.
Well, thank you very much, Michael, for that nice introduction. And I'm very happy to be working with your firm with respect to the coming conference. Um, Global zombies is the topic of our research, as you know, and it is a very relevant question as to how important are they and what does our study show and do that is different from perhaps others that have written about this subject, and how important is the zombie question. I think it's quite important, but it's kind of a below the surface type of importance from the standpoint of policymakers, because they don't really, focus on things like zombie firms in their regulation and in their growth and sustainability policies. But if you have a relatively large proportion of your companies, both listed and non-listed in an economy, that are basically not productive or in fact insolvent, but somehow manage to survive, whether it's based on a government or a banking or an investor support bailout, if you will, then in the long run, those economies are going to suffer because those resources that are necessary to sustain these firms could be used much more productively elsewhere. So it's kind of an opportunity cost question that is, very difficult to quantify for policymakers and bankers and investors, but it is below the surface a very important one with respect to its potential impact on the growth, GDP, and productivity of a nation.
Do
Our
you
study,
do you think? Sorry to interrupt, but do you
right.
think governments missed this point when they were handing out financial support to companies? Do you think they didn't think about the fact that we can now see that they've been supporting failing companies?
Actually, that's a great question because I would guess that the motivation for bailouts, especially if it's coming from the government, does consider the positive aspects of having zombies, such as employment. So they're concerned about the unemployment that could take place if these zombies went bankrupt and were liquidated, for example. Or the company may be strategic to the country, such as a national airline or something to do with the defense industry, military support. And so there are good reasons for supporting usually very large companies in an economy. But when it comes to a broad level of support across many sectors, across many sizes of firms, many industries, then I think there's a cost that is not weighed carefully by the supporter. And they only look at the potential positive aspects. One other supporter that is perhaps even more important than governments are banks. Now, banks in the past have supported companies when, in fact, they probably should have written them off in order not to recognize losses on their balance sheet and income statement for that year. And so they prolong this. They may give an interest-only loan, for example, to keep the company afloat. And this has real costs because those monies could be used to support and invest in more productive companies. Finally, and this one is a subtle point, but an important one, I think that supporting zombies adds to the potential deflation of an economy. And in today's market of inflation, high inflation, that's not an important issue. But it was just a few years ago, as you remember, in Europe, when deflation was a very important negative. And you could have deflation focused on zombies because those firms oftentimes lower their prices to try to survive, but they are met with even lower prices for more stronger, healthier companies in the same sector. And so that vicious cycle of consecutive lower prices can add to the deflation. Overall, I would say that another relevant question is how prominent are these zombies? And that is one of the issues that we address in our paper.
Because
And
zombie companies are nothing new, of course. I mean, they've been around for decades, but
exactly.
most of us think that there are a lot more around now than there were before because of the government support. Is that the case?
Absolutely. In fact, I'll just give you a quick statistic, and then we can move on. In 1990, our estimates, and we look at the 30 largest countries in the world and their zombies, and we measure it in a fairly unique way that I'd be happy to go into in depth in my speech on May 23rd. But we have a unique way of identifying zombies. Based on their interest coverage and the Z-score model, which you mentioned before. And the firms that look like they should have gone bankrupt but don't enter into our definition. And just to give you a statistic, back in 1990, there were about 1.5% of listed stock exchange listed companies in the world that qualified as zombies. And today, that number is about 7%. So it has
Wow.
increased dramatically. And I think there are a lot of reasons for that I will, don't have time now, but I will go into in my formal speech. But the point is, very definitely, zombies are an important factor that need to be considered not only by governments, but by investors and bankers and equity and debt holders in terms of their support, because we also look at what eventually happens to these zombies. And a significant number either get delisted in their, if they are listed companies, or go bankrupt anyway. But it takes 4 or 5 years for that to happen. And in that period, there's a big cost to the economy.
Okay, so a very significant increase in the prevalence of zombie companies
Yeah, absolutely.
at the moment compared to 3 decades ago. Um, Professor Altman, I also want to ask you about the post-pandemic period that we're in. I mean, how do you see the outlook for lenders at the moment and in, let's say, the near to medium future? Because we are, of course, faced with much higher interest rates than we're used to. We've got many economies in downturn, on the brink of recession, some of them. Um, what does this mean for banks and other lenders? How concerned should they be? Is this very different to previous? Um, I'm thinking about the banking crisis, 2008, 2009. Is this very different to that? How worrying? Bearing in mind, our audience are primarily lenders and financiers. How worried should they be about the future?
Well, that's a very relevant question in today's market, very much so. And I've written a piece about that I can send to, where we are in the credit cycle is the name of the piece. And I can send it to you, and you can make it available to your registrants at the conference. But basically, until this year, with the exception of a few months when the pandemic started in February and March of 2020, since 2010, since the last financial crisis, we have been living in what I call a benign credit cycle. Low default rates, high recovery rates if there are defaults, low required rates of return on the part of investors, low interest rates, certainly, particularly in Europe, but also in the US, which of course were exacerbated by the pandemic period. And so it was a very good market for lenders in the sense that defaults were low, et cetera. This year, for the first time in probably more than 10 years, I think we are facing what I would call an average credit cycle in terms of defaults, recoveries, yield spreads, liquidity, etc. Now, average, however, is misleading in a sense. What I mean by average is I think we can expect, lenders can expect, a big increase in default rates over the next 12 months, but not beyond the average over the last, say, 30 or 40 years, because we're at a very low level in 2021 and 2022. But defaults will increase, I'm absolutely sure, and I think most credit rating agencies are forecasting an increase in default rates, an increase in required rates of return of investors, et cetera, in 2023. My concern is that this increase in default rates from 2021, when it was very low, 2022 somewhat higher but below average, and 2023, which I think will be average or slightly above average, is oftentimes, in my experience over the last 50 years of looking at credit cycles, oftentimes a leading indicator of a serious recession and potentially a highly distressed economy with respect to lender defaults. In fact, we will show this carefully that four last recessions in the United States were preceded by this escalation of default rates from below average to average and then way above average when the recession sets in. And so, yes, we are in for a much more stressed period
So that's
for
a
lenders,
rather
for
worrying picture.
borrowers. And by the way, I'd like to add one more thing, Michael. Uh, I think there's also the impact now that when from the banking near crisis that we had in the United States with Silicon Valley and Signature, etc. Um, Bankers now are tightening their lending standards fairly dramatically. This actually started before Silicon Valley, but has escalated. And as a result, there's going to be a rationing out of credit, particularly for small and medium sized firms. And one thing that I'm very proud of, but also interested in reaching the audience about, is the fact that I co founded recently a small fintech credit analytic firm focusing on small and medium sized firms. And we're based in London, called Wiser Funding. And that our objective is to provide lenders with a modern analytic tool to assess the credit health of particularly small and medium-sized firms, both public and privately owned.
Which
And
sounds
this,
like that's going to be very useful in the
well,
near to medium future. Um,
we think so too, but thank you.
yeah, Professor Orman, I'm going to stop you there because I don't want you to give away too much prior to the to your presentation next month. But I think that's given a very nice flavour to what's obviously, clearly to me anyway, is going to be a very interesting presentation next month, and a lot to be said about what's happening in the current environment, lending environment, now and in the near to medium future. Professor Altman, thank you very much for your time today. And just to reiterate, Professor Altman will be speaking at Receivables Finance International Convention, which is on the 23rd and 24th of May in London. And if you'd like to attend, please go to the BCR Publishing website where you can download the program and you can book your tickets. Once again, Professor Altman, thank you very much for your time today.
Thank you, Michael.